This question is more focused on Mayar. Question is, what is the biggest misconception investors currently might have about your portfolio or investment philosophy going into 2026?
Interesting. That's a very interesting one. I think one misconception could be that we don't like growth companies and we don't like technology. And I don't think this is true. I think it's a misconception about where things stand today, or the way that we don't like the US and then we only like certain types of businesses. In the end, our job is to make an investment decision based on the information that we have that will help us kind of try and look at the future and see whether the price we pay today is low enough to protect us from the scenarios where what we want to happen doesn't happen. So I think this is kind of the core of what we think. And I think the misconception is people think that we'll just fixate on a certain low multiple or something like that. And that's not true. The way we think about it is we're going to think about 1,000 scenarios about the future. And we want to pay a price where, I don't know, 70% of those scenarios do not produce a permanent loss of capital for us. And kind of this is how we, at least, I think this is how I think about what value investing is, in that there are going to be many versions of the future that we don't know. And we just want to make sure that in the overwhelming majority of them, we do well. And in the ones where we don't do well, we don't do too badly. And today, in the US market overall, and certainly technology stocks, it's the other way around, where the overwhelming majority of scenarios in the future, you don't do well. And in a small minority or a decent minority of scenarios, you do very badly. So it's a flip of what we like. And so I think that's probably one big philosophical difference. I don't know, Obi, I may have kind of rambled too much and maybe you could put it.
No, I think that's absolutely right. You know, people seem to think that we don't like tech, where we do, but also people think that we're not necessarily exposed to tech. But we are, and sometimes it's directly. So, for instance, through Capgemini, where we believe that the sort of consultancy and systems integration element is essential to any corporation actually implementing AI, you know, in any widespread sense. But then we also, you know, have exposure in other ways that, you know, so. Well, actually, recently we sold down a bit of Richemont. You know, now, it may seem odd that we'd say that that's exposed to tech, but actually the wealth effect in the US has been so driven by tech that this means that people have been able to buy, you know, bracelets, you know, necklaces from Cartier and watches from Cartier. You know, so when we look at our portfolio, we actually do see exposure, but often it's not direct. And, you know, so we, you know, again, as you say, try and balance it. But I think the other misconception investors do sometimes have about us is that they don't, I just wonder if investors fully appreciate that there is a dual mandate for active fund managers: outperformance and reducing risk. And these are two things that we have to balance. And it's very easy to see out or underperformance. But measuring the risk we take is very, very difficult. And you can't measure it simply with volatility. Volatility is one measure that helps, but it is one of many measures. And most of the ways to really look at it are very much theoretical. You know, it's when we think about what is the downside to our portfolio and to the market and to other stocks, this is our estimate of what we think might happen in the future, or what might have happened. And we take lower risk than the market. Now, sometimes that pays off for us, and sometimes it doesn't. But we want to preserve the absolute capital value of our clients. We want to preserve our clients' capital. You know, that really is the most important thing. And I think just sometimes it's not easy to see how we actually do that, and it's impossible to measure what might have happened but didn't happen.
Yeah, I think that's a great point. I think this reminds me of that Joel Greenblatt quote, where it's like, just because you run through a dynamite factory with a lit match and survive to tell the story doesn't mean that you're not an idiot. And this is the problem with risk is after the fact, you only see what happened. You don't see all the other scenarios that did not happen. Over long periods of time, if you keep doing stupid things and taking stupid risks, you eventually blow up. But that only shows up over a 20, 30, 40, 50-year time frame, over any short period of time. And even 10 years is a short period of time in a probabilistic sense. The risks you avoid don't show up kind of in the track record. I'd like to add actually one more thing in terms of misconceptions, which is a conversation I've been having. I've been in Saudi for the past couple of weeks, and it's a conversation I've been having, which is that people think we somehow don't believe AI is real and don't think AI is going to be revolutionary. That's absolutely not true. We do think it's real. We do think it's revolutionary. We do think it's going to have a big impact. Our issue isn't with AI as a technology. Our issue is with the evaluation of AI stocks these days. And just like the internet changed the world in the 2000s and up till today, we think this is going to happen again with AI. But it was equally stupid to buy a basket of internet stocks in 1998 and 1999. So there's a distinction between the stocks and the technology and the businesses that are involved. So I think that's also another misconception.